So just to start, I'd like to thank Bench for having me. It's great to, I'd say, be back, actually. The last time I did this was in Russia, about 3 years ago. So I was very interested to see Daniel's statistic that Russia actually is one of the fastest growing investors in Sub-Saharan Africa. That's a statistic which very, very rarely comes up. So that was very encouraging. I'd also like to say that I don't have a pin. I feel like I should deserve one, having done so much of this world's landmass. It would be nice to have that. I've got 20 minutes or so. So what I wanted to do was to really go into the real estate sector, to talk about what's happening in the world, what's happening in the real estate cycle, what's happening in hotels, why does it matter for Sub-Saharan Africa, and then try and draw some conclusions. By way of introduction, I head the advisory team for Jones Lang LaSalle for Sub-Saharan Africa. We have a very experienced dedicated hotels team, led by Zander, who I'm sure most of you in this room know. Our hotels team at JLL work in 46 countries. We have offices in 5 African countries, and they've advised on close to $500 million of deals in this continent, in Sub-Saharan Africa. I'm sure you'll get a chance to talk to Zander and his team at some stage today. I'd also like to say that we do have a lot of wealth of documentation and, if this thing stays in, and various reports as well, which if you get a chance, I really encourage you to pick up. So just to start, I've got a few more charts perhaps, but I'll try and not keep it too dry. I want to just make, sorry, I'm playing with my ear, it's because this thing's falling out. I just want to start by looking at the broad real estate cycle, because it's fundamentally important. And I think when we specialize in sectors, I do all sectors, it's very important to be able to contextualize where hotels stand in that and where we are in the cycle. Because I'm sure, as you're aware, we're very much at the latter stage of the real estate cycle, running from the global financial crisis through to where we are now. So if you look at this chart here, and say it looks a little bit dry, but it is actually quite important. And I'm going to see if the laser works here. It doesn't work, it doesn't matter. So what you can see here is it's a tracking of all investment volumes that go into real estate, direct real estate transactions in Europe, Middle and Eastern Africa. It includes hotels, and we run it from 2007. This is proprietary JLL data. We track this. We track every single transaction over $5 million. And you can see a very, very clear cycle. If you look at the bars, they're measured every quarter. Where there's a red bar, you can see that there's a year-on-year decline for that quarter. So you can see big sell-off through the global financial crisis. You can see a little bit of a jitter from 2011, 2012, which is the Eurozone crisis. Brexit had a big impact on volumes because the UK is such a large contributor to total EMEA volumes in real estate. If you were to index those lines, you see something quite interesting, which is important for hotels. In fact, it's a fundamental driver for hotels, and it's one of the reasons why hotels behaves quite differently to the commercial real estate sector on this continent. And that's the strength of the European economy. And to an extent, the US economy, although volumes in the US have started to taper off a little bit, largely because there's not a lot of product entering the market, so that just overall sales volumes are down. But if you take that black line, that's an indexed or a rebased number, which is pretty conclusive evidence that the combination of quantitative easing, accelerated growth, sort of improving inflation, we don't longer talk about deflation in Europe, has created a very positive environment for real estate. We have record volumes, we have record yields, which to some extent is a worry. Buying anything in real estate in Europe is extremely expensive. You know, even Germany now, you're buying product at less than 3%, and German offices never traded below 4 ever. If you wanted to buy central Paris, you're buying at 2.5% yield. Even if you want to buy in Europe, in Eastern Europe, you're buying in the mid-4s now. So it's extremely expensive. Capital values are the highest they've ever been. Yields are the lowest they've ever been. So that's prompting a lot of nervousness. But the interesting way that capital is behaving is it's not actually within the commercial space moving up the risk curve. It's doubling down on core, which is very important for hotel sector. So what we've seen is extremely strong volumes in alternative sectors in core markets. There is a point about South African capital, and again, this is an important contrast to the way that the hotel sector is behaving on this continent, is that South African capital largely has ignored the rest of the continent, and mostly has gone into emerging Europe and Western Europe. About $14 billion of South African capital, real estate capital, has left South Africa and gone into Europe. Now, we are at an interesting inflection point, perhaps, where some of that capital is now starting to take Sub-Saharan African assets a bit more seriously, but still, it's very different to the way that hotels are behaving. And one of the points that we would make is that there is a maturation in the way that the hotel sector is behaving globally, and that's also being echoed in Sub-Saharan Africa. So, if we break down those hotel numbers, it's you know, of the 250 to 280 billion dollars that go into euros that go into real estate in general, we've got about 50 billion into global hotels for 2018. In Sub-Saharan Africa, we've got about $350 million of liquidity. In the short term, that could rise to about $500 million. Now, what's fundamentally different between hotels and the rest of the commercial real estate sector in Sub-Saharan Africa is that the development pipeline is actually very strong as well. There's far more liquidity coming into the market. That makes a big difference because there's a lot more product to buy. And one of the challenges that we see in the commercial sector is there's quite a lot of capital now chasing quite a limited number of assets. And perhaps in the hotel sector, that backlog is easier to clear. Now, one of the big global changes that we've seen in the global real estate market is that hotels used to be a specialist sector. We always classed as alternatives. Indeed, at JLL, hotels is almost a separate sort of entity or business within the JLL umbrella. It's carved its own niche, and that goes back for quite a long way. There's good historical reasons why that's the case. If you go back 10 years and you look at the market shares of the big buyers in the hospitality sector, largely specialist groups. And in fact, even a couple of those names now have rechanged, and they were huge then, and you wouldn't recognize them now. If you look at the last couple of years, it's the same buyers that are buying commercial are buying hotels. So the big pension funds, insurance groups, Blackstones, it's treated much more as a regular asset class. And to an extent, that's the same in Sub-Saharan Africa, but not quite to the same extent. But it is certainly the case that more and more money is being raised for funds in Sub-Saharan Africa. And I think that's why this is an important inflection point. This year is a very exciting year because for the first time, I think, we're really seeing a lot of momentum getting behind the sector. So just to break down a couple of the names there, and I know a few of these guys are in the room, of course. You know, Grit just raised $120 million in London for an LSE listing. That's so important for sentiment because it's the first time that a dedicated African real estate fund has done that. Obviously, Accor Qatar, that's $1 billion, $500 million of equity, a strong, solid commitment to the Sub-Saharan African space. CDC, CIC tie-up in Onoma, that could be, with CDC, it could be almost, I mean, you could touch on many points there. I mean, it's not just hospitality, you know, the tremendous success stories in Kenya in the logistics space. And in fact, if you want a good, positive story about what can be done in Sub-Saharan Africa, look at CDC and the IFC and their involvement in Tartu with Rendezvous developing, Rendezvous providing land for Africa Logistics Properties, delivering warehouse space on budget, on time, and be fully leased. It can be done, and that's a good example of how that sort of capital can get projects off the ground. And then a slightly sort of the next stage of the cycle, you know, seeing fundraisers from Growthpoint Investec with the IFC backing that as well. You know, these are serious capital raises that can make a material difference in the commercial real estate space. HPF, you know, if that, the unbundling and so goes Sun, you know, we could see one of the largest, if not the largest, I'll be corrected, happy to stand corrected, South African listed property funds is going to be a hospitality play, which is it's a significant change in the way that the market views the maturity of the hotel sector and the hospitality sector on this continent. And I've put in the British government, and I'm very pleased that Daniel had a picture of Theresa May, because every single conference I speak at now, since, which is actually only about 3 now, since Theresa May was in Africa, has a picture of Theresa May. Now, I know that Nigeria, where we always sort of seems to have negative news, Nigeria escaped from this. So only South Africa and Kenya. But it is important. I mean, jokes aside, I think the commitment from the UK, first, I think you can be cynical. It's heavily politicized. That is the first trip by a British politician, leader, I should say, serious politician, not say serious politician, to Africa in 7 years. At the same time, I think Macron has now done his 9th visit. It could be his 8th. I mean, it's extraordinary how far behind the UK is compared to our European peers. I am British, but I live in South Africa. It's extraordinary how far behind we are. But nonetheless, it is a commitment, and it does open up the routes for the great work that groups like CDC have been doing in the past. A little bit drier. Sub-Saharan African real estate behaves very differently to developed markets. And I want to pick up on a couple of interesting points. In developed markets, why is pricing at record levels? Why are yields so low? Well, it's largely because real estate sentiment and real estate investment is driven almost completely by policies rather than politics. So if you look at this chart here, there's two lines, a red one and a black one. The red line is simply the S&P, and you can see it running through the cycles from 1990. And the black line is the VIX volatility index, which is just a good gauge of general sentiment and volatility in the markets. If you look at that red line, you can see that despite all the volatility, particularly the Eurozone crisis, the Italian government debt crisis, when volatility has peaked, it hasn't made a jot of difference to the way that real estate is viewed. Spain can run without a government. Belgium can run without a government. Literally nobody cares. Everyone keeps buying real estate. What that has meant, therefore, is that this policy of quantitative easing, which is driving cheap money in the US and in Europe, is really largely behind this growth in real estate. Now, what about in Sub-Saharan Africa? It's not the case. This argument really doesn't hold. If you look at the example of Kenya, where actually you've got one of the strongest, most stable growth profiles on the continent, however you cut it, you're north of 4.5% consistently in terms of annual real GDP growth. There's very few markets in the world that can achieve that. I mean, that's sort of emerging Asia levels of growth. Yet investment volumes in Kenya have been significantly muted by the election cycle of last year, despite all the evidence that this is actually a very sound economy and is making tremendous progress. And you can take that example in many, many other cases on the continent. Nigeria is about to go into an election cycle. What are we concerned about in Nigeria? Well, cyclical volatility, but also the election cycle. The other thing, and Daniel picked up on this, is this obsession with Eurobonds. I would also point that it's not just a Eurobond story. It's also a Chinese story. I mean, I'm slightly more sanguine on the relationship that African countries have with the Chinese. The average interest rate at which the Chinese lend to Africa is 3.7%. The average maturity is 16 years. So it's actually, it's not as cheap as the World Bank or IFC, but it's certainly cheaper than a Eurobond, and less volatile. But certainly it's the case that debt levels have been rising, and this chart echoes the previous chart. Now, why does that matter? Because if we want to have something to watch out for, it's the extent to which global volatility is imported into Sub-Saharan Africa, and this is fundamentally important for the real estate market. Definitely it's the case, like I said, that policies rather than politics are important in developed markets, and it's the opposite in Africa, except for this. So this is the blended African Eurobond yield through this year, running up to June, July. You can see that weight of capital that flooded in to African Eurobonds through 2017, really sold off aggressively this year, a function of the stronger dollar, US Treasuries going through 3%, and obviously worries about trade disputes with China. Started to improve, though, through the third quarter, interestingly. There's actually some pretty good news. I mean, Nigeria has paid off a $300 million Eurobond from 2013. Ghana has been upgraded to B by S&P. Angola has raised $500 million. They're buying into IFC programs, strong commitments on reform and corruption. But definitely, a lot of volatility potentially imported through this stronger dollar And obviously, with the interest rate cycle being where it is, the dollar is only likely to strengthen over time. That leaves a lot of African countries quite vulnerable. What does that mean? Well, you see volatility and you see sell-offs. Then what happens? Well, the market floods into places of safety, which is the dollar strengthens, and you get quite a dangerous cycle. But like I said, although we should be aware of it, it's not all necessarily bad news. On that point about the interest rate cycle, a couple of things are quite important. If you track the European policy rate versus the Fed's over time, and again, this matters because of all the dollar exposure that there is in Africa at the moment, when the Fed moves, sooner or later, the ECB move, historically, those little grey lines show the gap between a Fed move and a European move. They're typically quite short, 6 months, 8 months, 9 months. This period now is an extremely elongated process that the ECB keeps holding off its move. And I think for the hotel sector, because there's such a strong correlation between European growth, and it's European growth that has really supported a lot of the hotel investment story in Sub-Saharan Africa, once we start seeing this interest rate cycle kicking in for Europe, again, it creates some interesting dynamics for the hotel market. But however, one should note that if the interest rate cycle is kicking in Europe, it's because economic growth is so strong, and because disposable income is strong, and because inflation is strong. I tried not to put a chart on in GDP, but I wanted to make this point about momentum, which particularly relates to this discussion around the capital raises, and why has capital been quite willing to commit to some of these big funds, relatively big funds, that have been raising capital for Africa. And it's not, by the way, it's institutional capital. I mean, there's quite a lot of American money, even American institutional money, coming into these capital raises. And I think the answer lies around momentum in GDP growth, rather than just taking a snapshot and saying GDP in South Africa and Nigeria and Angola is extremely disappointing because it struggles to get above 2%, and in Kenya and Tanzania and Ethiopia it's extremely strong because it's generally always above 4.5%, 5%. Just taking that growth over a period of time perhaps plays into that feeling of sentiment. If you do that, and a lot of this is due to the sort of pro-cyclical fiscal policies that a lot of these countries adopt, and cyclical nature or the volatile nature of these countries' economies, you see that countries like Nigeria actually have a relatively accelerated improvement in GDP. And Sub-Saharan Africa as a whole. And actually, if you take Sub-Saharan Africa and you strip out some of the laggards, it is an emerging Asia growth story. As you move to the right of that, you can say, well, there's a silver lining. Kenya has a relatively low acceleration in growth, but that's only because growth here is actually quite stable, and that's the case for a lot of the East African countries. So there is a positive story. Now, one of the things that we do at JLL is we map transparency, and you can pick up a copy of our transparency report. We do a global transparency report because we like to benchmark progress in transparency in all the countries of significance in the world. In Africa, we measure transparency in 15 countries. 5 years ago, it was just South Africa. Now it's 15. So we have a really strong level of visibility on transparency. What do we mean by real estate transparency? Well, there's a number of factors that play into that. Performance monitoring, market fundamentals, governance, regulation, sustainability, the process of transaction, the ease of transacting on this continent. We all measure those and we benchmark them against other countries. Now, why am I mentioning it here? It's because this enthusiasm and this change, this sort of sentiment towards Africa, is measured by significant improvements in transparency. And we know from history that transparency drives a number of fundamentally important things in real estate. Investment and business efficiency is the key for Sub-Saharan Africa. And if we look at the two biggest improvers over time, and this year in particular, it's Kenya and Nigeria. And here we've just taken transparency against transaction volumes, and you can see, obviously South Africa is one of the more transparent markets on the continent, although arguably, given that we have quite a high weighting for the governance of listed entities, the challenges around the resilient or the fortress group possibly indicate that South Africa is not in a position, from a regulatory point of view, to criticize the rest of Africa. So Nigeria and Kenya are making huge progress. And why is that the case? It's largely because data is becoming more uniform and better monitored. It's not just JLL who do that, although I say that we do, but it could be Brawl, it could be any of our competitors as well. Proper data, and also proper business service provisions. So valuation, for example, we have a big valuation team in Africa. I mean, they're too busy. They're growing so rapidly. There's a real need and demand for proper standards. And that sort of thing drives investment, drives transparency, which drives investment. And a final point, when we relate back to this idea of improving sentiment towards Sub-Saharan Africa, the other thing that our hotels team do with Zander is they measure perceptions of sentiment amongst the hospitality community in Africa. It paints a broadly positive picture. And it does suggest that we're coming out of a cycle where we've really, I think, and certainly in the commercial space, we've had a very poor sentiment towards Africa. Certainly from 2014 to 2016, and then tail end of it through 2017. That correction in oil price, this high cyclicality of the oil exporting countries created a real dampener. I think it's changing, and this is evidence that it is changing, and certainly within the hospitality sector. 50%, or 60%, I should say, of hotel investors in Sub-Saharan Africa are looking to increase their investment. And importantly, they're looking to do that over the long term as well. So this capital that's coming into Africa is also supported by an improvement in sentiment. It's supported by more products, more depth, more transparency, better regulation. And although we're not there yet, it's a very encouraging and supportive environment in which to be operating. And that's it. Just as the logo is.